A drug trafficker walked into a TD Bank branch and deposited over $1 million in cash in a single day. Then he did it again and again for years. At one point, he bribed bank employees with gift cards to keep the accounts open. He later told investigators he had specifically chosen TD Bank and not its competitors because it had what he described as the most permissive policies. In October 2024, TD Bank pleaded guilty to money laundering. The fine, $3 billion. This is how one of North America's largest banks became, in the words of federal prosecutors, a bank for drug cartels. Welcome to the Compliance Edge, where we cover the compliance failures that cost companies billions and show you exactly how it happens. Let's get into this one. Before we go into what TD Bank did, or failed to do, it helps to understand what money laundering actually is and why banks are the critical checkpoint. When criminal organizations make money, from drugs, fraud, trafficking, or any other illegal activity, that money is essentially unusable in the legitimate economy. You can't buy a house with $2 million in cash and explain where it came from. You can't invest it. You can't move it across borders without raising flags. So criminals need to make dirty money look clean. This is money laundering. The process typically involves 3 stages. First, placement. Getting the cash into the financial system, usually in smaller deposits to avoid detection. Second, layering. Moving the money through a series of transactions to obscure its origin. Third, integration. Reintroducing it into the legitimate economy in a form that appears legal. Banks are the gatekeepers at the first stage. They are legally required to monitor transactions, identify suspicious activity, and report it to government authorities. This is called anti-money laundering compliance. AML. Every bank in the United States is required by law to have a functioning AML program. The rules are strict, the reporting requirements are detailed, and the penalties for failure are severe. TD Bank knew all of this. It was one of the 10 largest banks in the United States, and it failed, systematically and for years, to do any of it properly. The failure at TD Bank was not the result of a few rogue employees, it was structural. The bank operated under an internal policy referred to as the flat cost paradigm. Senior executives had imposed a budget mandate requiring that TD Bank's operational costs not increase year over year, regardless of how much the bank grew, and regardless of how much its risk profile changed. In practice, this meant the AML compliance program was chronically underfunded and understaffed. As the bank expanded, as its transaction volumes grew, as the risk increased, the compliance function stayed flat. The result was a monitoring system that didn't work. Between 2014 and 2023, TD Bank failed to adequately monitor over $18.3 trillion in customer transactions. That is not a typo. $18 trillion in activity went through the bank without proper scrutiny. Within that gap, 3 separate money laundering networks operated for years without being stopped. In the first scheme, a single individual moved more than $470 million in drug proceeds and other illicit funds through TD Bank branches. He bribed bank employees with gift cards, more than $57,000 worth in total, to keep accounts open and avoid scrutiny. On multiple occasions, he deposited over $1 million in cash in a single day at a single branch. He later told investigators he had selected TD Bank deliberately over other options, specifically because its policies were the most permissive. In a second scheme, 5 TD Bank employees, working with criminal organizations, opened and maintained bank accounts that were used to launder $39 million to Colombia. The money included drug proceeds. 2 of those employees faced criminal charges. In a third scheme, a network used TD Bank accounts to facilitate transfers connected to fentanyl trafficking. These were not isolated incidents. They were separate operations, running in parallel, inside the same institution. It was not TD Bank's own compliance team that caught it. Law enforcement investigations into the criminal networks eventually led back to TD Bank accounts. The U.S. Department of Justice and the Financial Crimes Enforcement Network, FinCEN, launched a coordinated investigation into the bank's AML program. What they found was a compliance function that existed on paper, but not in practice. Transaction monitoring alerts were routinely dismissed. Suspicious activity reports were filed late or not at all. The internal controls that were supposed to catch exactly this kind of activity had been hollowed out by years of cost-cutting.
Federal prosecutors described TD Bank's failures as long-term, pervasive, and systemic.
Not an oversight, not a gap. A complete breakdown of the controls the bank was legally required to maintain.
On October 10, 2024, TD Bank pleaded guilty to conspiracy to commit money laundering, making it the largest bank in American history to do so.
The penalties were significant. TD Bank paid $1.8 billion to the U.S. Department of Justice. It paid a separate $1.3 billion to FinCEN, a record fine for a bank under the Bank Secrecy Act. Total penalties, over $3 billion, but the financial penalty was not the most consequential part of the settlement.
As a condition of the plea agreement, TD Bank was placed under an asset cap, meaning it cannot grow its U.S. retail banking operations beyond their current size until it has demonstrated full remediation of its AML program. This is the same type of restriction that was placed on Wells Fargo after its fake account scandal in 2016. And Wells Fargo spent years operating under it.
For a bank whose growth strategy depends on expanding in the U.S. market, this is potentially more damaging than the fine. Several bank executives have also left the organization since the investigation began. And the Department of Justice has indicated that further charges against individuals remain possible. The TD Bank case is significant for several reasons. First, it demonstrates that AML compliance is not optional, and cost-cutting within compliance functions is not a legitimate business strategy. The flat cost paradigm that drove the failures at TD Bank will now become a case study in exactly what not to do. Second, it shows that regulators are willing to impose structural consequences, not just fines, on institutions that fail systemically. The asset cap is a direct constraint on business operations, not just a check written and forgotten. Third, and perhaps most importantly, it highlights the real-world consequences of compliance failures. The $670 million that moved through TD Bank's accounts was not abstract financial crime. It was, in significant part, drug money generated by the fentanyl trade that has caused tens of thousands of deaths across North America. When compliance breaks down at a bank, people don't just lose money. In cases like this, they lose lives. TD Bank's story is a reminder that compliance is not a bureaucratic checkbox. It is the infrastructure that keeps the financial system from being used as a tool by the people who want to do the most harm. When executives decide that compliance costs too much, they are not just making a business decision. They are making a decision about what the institution will allow and what it will enable. This channel exists to tell exactly these kinds of stories, clearly, accurately, and without jargon. If you found this useful, subscribe to The Compliance Edge. New videos every week. See you in the next one.